Welcome to StockTok's deep dive into BHP Group Ltd. BHP is one of the world's largest diversified mining and petroleum companies, with major operations in iron ore, copper, coal, and liquefied natural gas. The company extracts and processes these commodities for global industrial and energy markets, competing on scale, cost efficiency, and access to world-class ore bodies. As of May 8th, the stock is trading at $84.72. Over the past 52 weeks, the stock has ranged from $45.74 to $85.14, putting the current price near the upper end of that range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. BHP generates revenue by mining and selling bulk commodities, iron ore, copper, coal, and liquefied natural gas, primarily to industrial manufacturers and energy consumers in Asia, Europe, and North America. The company's competitive moat rests on three pillars. First, scale. BHP operates some of the world's largest, lowest-cost mines, which gives it pricing power when commodity markets weaken and superior returns when they strengthen. Second, asset quality. Decades of exploration have given BHP access to ore bodies with decades of remaining reserves, creating a durable cost advantage over smaller competitors. Third, operational execution. Management has built a track record of safe, reliable production at world-class efficiency. The StockTok score for BHP is 36 out of 100, which signals caution. Valuation ranks critically weak at 4 out of 20. Financial health is modest at 11 out of 20. Profitability is solid at 16 out of 20. Growth is very weak at 3 out of 20. And smart money positioning is extremely weak at 2 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? BHP is trading a price-to-earnings multiple of 19.63 times trailing 12-month profits. On a forward basis, that is, using next year's expected earnings, the multiple is 19.35 times. Both multiples are elevated. The PEG ratio, which divides the PE by the expected earnings growth rate, sits at 5.53. A PEG below 2 is generally considered attractive. Anything above 3 suggests the market may be pricing in growth the company cannot deliver. At 5.53, the PEG is flashing a warning. On the enterprise value to EBITDA front, that is, the total market value of the company divided by earnings before interest, taxes, depreciation, and amortization, BHP trades at 7.7 times. That is not particularly expensive in absolute terms, but combined with the earnings multiples, it raises a yellow flag. Here is the critical number. Our DCF model, that is, a discounted cash flow analysis that values a company based on the present value of its future free cash flows, suggests the stock is trading at a 72.45% premium to intrinsic value. That is a substantial overvaluation. Wall Street analysts covering the stock have a consensus mean price target of $67, based on 7 analysts in aggregate. The high target is $89, the low is $56. The mean target of $67 implies downside of approximately 21% from current levels. Taking both signals together, a reasonable fair value range in our view sits between $56 and $70. Market sentiment around BHP leans bullish, bolstered by Goldman Sachs' recognition as a top gold stock pick, favorable copper supply and demand dynamics, and robust energy markets. However, that optimism is tempered by geopolitical tensions and mixed broader market performance. The setup is this: BHP is a profitable, cash-generative business, but the market is currently pricing in a rosier future than the fundamentals support. Valuation remains stretched in our view. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point financial health checklist that examines profitability, leverage, liquidity, and operational efficiency. BHP scores 4 out of 9, which is concerning. This suggests that while the company is profitable, it is showing some weakness in balance sheet trends and cash generation relative to the baseline. The Altman Z score, a bankruptcy risk model, comes in at 3.64. A score above 2.9 indicates a safe zone. BHP sits comfortably there. This is a healthy signal. The company is not at material risk of financial distress. Now, leverage. BHP carries a debt-to-equity ratio of 0.56, meaning debt is a bit more than half of shareholder equity. That is reasonable for a large, stable mining company. The company has a cash-to-debt ratio of 0.49. That means for every dollar of debt, BHP holds about 49 cents of cash. This is where caution emerges. The company is not sitting on a fortress balance sheet. Interest coverage. The ratio of operating earnings to interest expense stands at 10.97 times. That is solid. The company earns nearly $11 of operating profit for every dollar of interest it owes. The current ratio, which measures short-term liquidity, is 1.65. A ratio above 1.5 is generally healthy, and BHP hits that threshold. In summary, the balance sheet is safe. Solvency is not a near-term threat, but the company is not building fortress-like excess liquidity either. Leverage is moderate and manageable, which fits the profile of a mature, cash-generative commodity producer. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is 7.08%. That is the profit the company generates on every dollar of capital deployed in the business. For context, most investors target a return on invested capital above 10% as evidence of a durable competitive moat. At 14.08%, BHP exceeds that hurdle and demonstrates strong capital efficiency. The gross margin, the percentage of revenue left after direct production costs, stands at 71.65%. That is exceptional. Mining at that margin means BHP's ore bodies are economically advantaged, or its operational execution is superior, or both. The operating margin, which measures profit after all operating expenses, is 39.92%. This is remarkable for a commodity business. It reflects BHP's scale and cost leadership. The net profit margin, what the company keeps after all costs, taxes, and interest, is 18.96%. 1 in every $5 of revenue flows to the bottom line. The free cash flow margin, which measures cash the company generates and can return to shareholders or reinvest, is 19.05%. Critically, this margin is nearly identical to the net margin, which means the company is not trapped in a capital-intensive expansion cycle. Cash generation is aligned with profitability. Return on equity, which measures how much profit management generates on shareholder capital, is 21.34%. That is very strong. Return on assets is 9.32%. Together, these metrics paint a picture of a highly efficient, cash-generative machine. The bear case might argue that these margins are cyclical and subject to compression when commodity prices weaken. That is a legitimate concern, but on the data we see, BHP is squeezing substantial profit from every dollar of sales. On to growth. Is this business expanding and at what rate? This is where the thesis breaks down. Revenue growth over the trailing 3 years is negative 5.3%. The company is actually shrinking, not growing. Over the past 5 years, revenue growth is positive 5.5% annually, a modest clip. This bifurcation matters. It tells us BHP faced headwinds in recent years, but is stabilizing on a longer-term horizon. Book value growth, which measures the accumulation of shareholder equity over time, is 4.6% over 3 years. That is pedestrian. The dividend yield sits at 3.31%. BHP is returning cash to shareholders in the form of dividends, which is attractive to income investors. However, the yield does not compensate for the lack of earnings growth. The growth picture is the critical weakness in BHP's investment thesis. A commodity producer can justify a premium valuation only if it is growing volume, expanding margins through cost discipline, or acquiring productive assets at fair prices. BHP is facing commodity headwinds that are pressuring volume growth. Management has not demonstrated a compelling path to reignite organic expansion. The stock has already run higher this year, and the valuation we reviewed in Scene 3 does not leave much room for disappointment. Investors are paying for stability and cash returns, not for growth. That is a fair characterization of what BHP offers, a dividend-yielding, stable business in secular maturity. Now let's talk smart money, what institutional capital is actually doing with this name. 6 top-tier investment gurus currently hold BHP positions, according to our smart money tracker. That suggests experienced, long-term investors see enough fundamental merit to maintain stakes. However, institutional buying is weak. Only 4.5% of all institutional filers tracked by the SEC are net buyers of the stock in recent periods. That is far below the 50% threshold we would use to signal true institutional enthusiasm. The takeaway: the smart money is not rotating into BHP. They are holding positions they already own, but they are not aggressively adding. Insider ownership is 0%. Management owns essentially no stock. This is a red flag from a governance perspective. When executives have no skin in the game, their incentives are not perfectly aligned with long-term shareholders. Insider transactions over the past 3 months total 0 buys and 0 sells. There is no signal, neither negative nor positive, from company insiders about future prospects. They are simply not transacting. The pattern here is telling. BHP is a large, mature company that is held by some sophisticated investors, but is not attracting new institutional capital. Insiders are neither buying on weakness nor selling into strength. The smart money signal is essentially neutral to slightly negative. This reinforces the view that BHP is fairly valued at best, overvalued at worst, and lacking the fundamental momentum or insider conviction that would justify a contrarian accumulation. And finally, the verdict. Let's bring it all together. Valuation is stretched, trading at a significant premium to our estimated fair value. Financial strength is adequate but not fortress-like. The balance sheet is safe, but the company is not building excess liquidity. Profitability is genuinely impressive, with best-in-class margins and capital efficiency. Growth is the critical failure point. The company is not expanding and faces secular headwinds in certain commodity markets. Smart money positioning is neutral to slightly negative, with no new institutional inflows and no insider accumulation. In our view, a fair value range for BHP Group Ltd sits between $56 and $70, representing downside of approximately 18 to 22% from current levels. The thesis here is straightforward. BHP is a high-quality, cash-generative commodity producer with exceptional operational margins and stable dividends. However, it is a mature business in a cyclical sector, growing at a rate well below historical norms. The market is pricing it as if growth will reignite or margins will expand further. We remain skeptical of both. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on BHP Group Ltd. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.